Okay, well, good morning. I hope everybody's safe and warm and have water and power and obviously internet. So we have a lot to cover today. A lot of things have been happening. I met with you guys this time last year. I never would have thought that the year would have passed that we've had. So hopefully it won't happen again, actually. So, okay, crazy 2020. Let's hope it never happens again, at least for not another 100 years. And hopefully our weather now won't happen for another 100 years either, since this is a 100-year storm. So let's look at what the legislation and IRS regulations have passed that's going to impact you and your clients. There's a lot that have happened this last year, and I can't go over everything. So I tried to pick out the few things that I thought would help you and help your business and help your clients. So if you have any questions about this, there's a lot of information. We'll be going through it really fast. Please email me, contact me, and I can go over a lot more. There's also things that you probably are wondering about, and I didn't cover because, like I said, I'm trying to cover as much as I can. So please just email me. I love answering questions. It's never a problem. So let's get started. So the first thing was the Secure Act. Setting every community up for retirement enhancement. I don't know if you guys heard about this or not. It happened at the very beginning of the year when we really weren't into COVID yet. So we were just starting out. And what it did is it repealed the traditional IRA contributions ended at 70 and a half years old. You were not allowed to put anything into your IRA after 70 and a half. Well, with our life expectancy changing so much, they changed this so there's no limit whatsoever. You can contribute to your IRA as long as you want, which has really helped a lot of people out. Another thing that this did is it increased the RMDs, required minimum distributions, from 70 and a half to 72. Now, this only is effective for taxpayers who reach 70 and a half after 12/31/2019. So if you reached 70 and a half in 2020, then you don't have to take RMDs until 72. I had a lot of clients call me this last year wanting to stop their RMDs because they'd had started a year or so ago, but they don't qualify for that. They have to continue taking out their RMDs, which really isn't fair, but they didn't ask my opinion. This is an interesting one. 529 education plans. So you can pay for a beneficiary of the 529 plan or a qualified sibling without having to transfer the whole thing to the sibling. So before, when you had a child that wasn't going to go to college, you would transfer that 529 plan to the next child, but you had to do the entire amount. You couldn't do a small amount. So now you can just do up to until $10K, $10,000 per year to another child, and you can also use those the funds for that for K through 12 education, which changed this year too. So a lot of people have been taking out their 529 plans to pay for private education, especially with COVID happening this year, and they weren't planning on putting their children into private education, and they needed the money to help out with that. So this has been a really great benefit for a lot of taxpayers. Okay, elimination of the stretch option for beneficiaries of an IRA. So before, you had an unlimited amount of time to take out the inherited IRAs from your parent or grandparent, anybody but a spouse. That changed to 5 years. You had to take it out within 5 years, and now it's up to 10 years. So you have up to 10 years to take that money out of the account of the owner, the person that you inherited it from, and either roll it into your own name or take it out completely. So they're trying to stop the IRS retirement money from being rolled over into one generation after another. They're trying to get it out so they get obviously to get the tax money for that. I know there's going to be a lot of questions. I'm going to hopefully have some time at the end for some questions, so just hold on to that. There's just a lot to cover, and I'm hoping that we can get as much of it done and accomplished as possible. Okay, so that stretch IRA that excludes underage children beneficiaries because they are needing the money to help with their support. Spouses, of course. Other beneficiaries, non-spousal beneficiary, disabled beneficiaries, and those that were 10 years younger, the spouses that were 10 years younger than the decedent. So the rules are changed for those. Those are excluded. Again, this is for plans with where the person dies after 12/31/19. Doesn't apply to anyone before that. So good rule changes. High deductible health plans and expenses. You were never allowed to take them out for anything but specific reasons. Now they've expanded that to COVID. So you can take money out of your HSA to use for COVID-19, including testing and other costs that meets HDHP rules that do not normally. Whoops. Sorry about that. Should have been, thought that was off. Well, as you know, we had quite a few tax extensions last year. Tax returns generally were extended until July 15th of 2020 from April 15th. And with that changes a lot of other things. So normally when you have an extension, your taxes are still due on April 15th. And so if you file the extension, you don't have the late payment penalty. That's the only thing that saves you. You still have interest from 4/15, and you still have any underestimated tax penalties if you didn't pay enough estimated taxes in. Well, that all changed on this one time, so it pushed all of those penalties and interest back to 7/16. With that changes a lot of other information because all your audit and collection items also got changed to 7/15. And now when you have your statute of limitations, which is normally from 4/15, the last day for filing, it's going to be for this specific year. The statute of limitations won't be up until 7/15 of 2030, which is going to be one of those really weird things because we're always going to have to remember that 2030 or 2020 had a specific statute of limitation rules, and that's going to be for a long time. They'll be with us. So right now, IRS estimates they have about 3 million pieces of mail that has not been opened. So we have all of these collection items that were postponed and all of these different things that have happened that that started back up once the IRS starts getting back in there, but they're sending out the notices and everything without opening the mail. So a lot of people are getting notices of things that they mailed in 6 months ago. So normally the computer system is about 30 to 90 days behind. So now it's going to be 30 to 90 days behind whenever they get the mail open. So we've had a lot of problems with this. I've had people who mailed in checks 6 months ago that still haven't had their checks cashed because the mail is sitting in a truck somewhere. So if you do send anything into the IRS, you really need to fax it in. And if you make a payment, you need to go onto irs.gov and make your payment electronically. Do not mail a check in. It's really creating a lot of problems. Okay, so this is about what we were talking about before. You know, the IRS completely, when they open up for the exams and collections, and the automatic computers are going to be way behind, spitting out letters which have nothing to do with current reality. They're going to be 6 months late probably on the information, if the information is even there in there completely at all. We've had a lot of issues this year representing clients and trying to prove that they mailed in checks and prove that the mail just hasn't been opened yet, but it's been a difficult process. Need to be patient. We are all working under a new set of rules. The guidelines have not been pointed out to the workers. They have no idea what they're doing. A lot of them are, temporary employees. A lot of them are making $10 an hour and are just used to just opening mail and processing and really have no idea what they're doing. It's not the same process it used to be. Right now, we still only have like 2 IRS agents in each building. Most of them are still working from home. When you do fax something in, it goes in and someone opens up or checks the faxes and hopefully sends it to the right person. And with the limits on faxes and emails, all of the information isn't getting to the auditors. And so it's been a real problem this year. Okay, so let's talk about the economic impact payments. Everybody received those, hopefully. In theory, every adult was supposed to get $1,200, and if they claimed a dependent under 16 years old, they would get another $500. So it didn't include any dependents over 16 years and older, or college students, disabled adults, disabled family members, anything like that, if they were over 16 years old. To qualify, you had to have a valid Social Security number, no ITIN. You had to have filed a tax return for 2018 or 19. And then they were phased out for married at 150K to 199. And married filing jointly was 70 for married filing jointly, and then for singles and for head of household, it was 75 to 99K. The one rule was that this was not supposed to be used to offset taxes. So if you owed back taxes or college loans, it would not be offset. The only offset would be for child support. If you owed back child support, they would take the money for the back child support. And I found that happened about 50% of the time, not all cases. So if you did not receive the money in 2020, there was no way to tell them or let them know that you didn't receive the money. Obviously, the IRS wasn't in the offices. Nobody was answering the phone calls, and there was nobody to complain to. So they did create a refundable credit for 2020. So refundable meaning that if you didn't owe any taxes whatsoever, it didn't reduce your taxes. You'd actually receive the actual cash, just like you would on EITC or child tax credit. So the credit was based on 2019. If you filed 2019, if you hadn't filed 2019, it was based on 2018. And like I said, it's supposed to be reconciled on the 2020 tax return if you didn't receive it. It was also supposed to be reconciled on the 2020 tax return if you received more than you were supposed to get, but that changed also. So of course we ran into some glitches, a lot of glitches. One of the biggest glitches was the clients who went to a big box to file their tax returns. So if you went to Walmart and you went to their tax preparation desk and you filed it there, you generally got a Walmart card that your refund would go on, or something similar from H&R Block or any of the other ones. Well, after you spent the money, people just threw the card away. And so when they were wondering how they were going to get their refund, one of the issues was all the banks went to the IRS and said, if we're going to process these extra tax refunds for you, we want to take a piece of it because we're going to be responsible for that money. We have, cost of operations. IRS said, absolutely not. You can't have any of it. It has to go directly to the clients. So what happened is if you had any kind of rapid refund or any kind of refund going into a specialized product like a card from American Express or from H&R Block card or a Walmart card, anything else, those tax payments for the stimulus got rejected. They were sent back to the IRS, which would probably be about half of the tax preparer or tax payers at that time. Then they had to collect the money back and issue checks, which took a long time. Sometimes they issued cards, sometimes they issued checks. They didn't even let the people know that what they were doing. So some of them got lost in the mail. Some of them didn't even open the mail, not knowing what it was or thinking it was something else. So all of that is going to be taken into account when we do the 2020 tax return. It was quite a mess. But when you have somebody, you have an organization supposed to process a massive refund like that in 3 weeks, when normally it takes 3 months for them to even consider anything with 40-year-old operating systems, I think we did probably much better than I even expected us to be able to do, or them to be able to do. So we had 20-year-old college students who were independent in 2019, and so they did not get the $1,200. But in 2020, they were on their own. So parents were coming back to me and saying, can we amend our tax return to take him off the tax return for her so that she would be eligible to get the money? The problem is in 2019, if they were not eligible to, if they did not eligible to be on their own and they were able to be a dependent of somebody else, then they had to be the dependent. Basically, you can say that my college student made $1,200 last year and supported themselves. That wasn't possible. And if you had filed an amended return, it was going to take a year to process anyways. It was way too late. they wouldn't have received the money. So that didn't happen. Another big problem was people who had died in 12, 18, 19, or 20, and that people were receiving checks for them, and they wanted to know if they could still keep the money. The IRS said that they had to send the money back, but as professionals, we're still debating that because there's some new laws went into effect, and we'll talk about that in a minute. And what about kids that parents get to claim their kids every other year? So the son has joint custody of his daughter and claims her an odd number of years. Who gets the rebate? Well, if you filed in 2018 and you claimed your child or children, and you did not file in 2019, they're going to go by your 2018 tax return and send you the money, the stimulus money for your children also. So if the other spouse did her 2019 tax return or his 2019 tax return and filed for the same children based on the 2019 tax return, they also would get the stimulus money. And so that created a lot of worry about, who was going to have to send the money back. And it's been decided that they both get to keep it. So then under CARES 2, we had another set of EIP, and it was basically the same rules, $600 per person though, instead of $1,200 for adults and $500 for children. And again, there was no offsets for anything but for child support. So if you owed back taxes or anything else, you were to get the money. So 2020, how do we rectify all these people who did not receive their money or received too much? We have a stimulus credit check or check credit. So your tax preparer will be asking you how much you received on the stimulus 1 and stimulus 2. We have to put that on the tax return. And if you're missing any money that you were entitled to based on your 2020 information, so if you claim the children in 2020, then you would get the stimulus money if you did not receive it in 2019. Any overpayments will not have to be paid back. And they specifically said about for basically dependents and other adults that you receive money for. It did not specify for those who were deceased. But since they haven't come out with any other rulings regarding those who were deceased, we as professionals pretty much decided that you don't have to send it back for those who are deceased either. They have no mechanism to require that money back. So what about the college child who was claimed by a parent in 2019, but in 2020 is independent in claiming him or herself? Well, I actually had this situation. I claimed my college son in 2019. And so he did not receive the stimulus money, and I did not receive the stimulus money since he was over 16. So this year on his tax return, he's claiming himself because he's graduated and on his own, and he will be entitled to the stimulus money that he didn't get in 2019. And the non-custody parent in 2019, we talked about that also. So both set of parents are going to end up receiving the money. Okay, so charitable contributions. A lot of people were in need this year. I was giving money to the food banks, and I think everybody was giving money to somebody and helping them out that I know of anyways. So with the 2018 tax laws, most people do not benefit from their taxable and from their charities because they're taking the itemized deduction. And they're not itemizing deductions, they're taking the standard deduction. If you're married, filing jointly, it's over $24,000 before you would even start to itemize. And for single, it's $12,000, over $12,000. It goes up every year. So what they decided to do is to give a $300 above the line contribution. So on the schedule 1040, there is a new line saying that for $300 in charitable contributions, and it's $300 per tax return. It's not $300 for single and $600 for married filing jointly. It's $300 per tax return. And if you took more than the $300, like $600, you would get a 50% penalty on that amount. The $300 is the limit. Limitation on cash contributions did go up from 60% to 100%. and for corporations, 10% to 15%. So before, if you did itemize, you can only write off 60% of your income with charities. So if you made $100,000, you can only write off $60,000 in charities, and you'd still have $40,000 of taxable income. So for 2020, you're allowed to write off $100,000. So you could basically have no taxable income and give everything away to charity. And the corporations went from 10% of their taxable income to 15%. Here's another big one, retirement distribution plans. A lot of people had to take money out of their retirement plans to survive in 2020. The government realized this and realized that they're going to be they're basically creating a humongous tax liability for these taxpayers. So they came up with a plan. With the CARES Act, you can take money out. There's several things you can do, actually. Just start from the beginning. You can take distributions from your pension plan, retirements, without paying an early withdrawal. So if you're under 59.5 right now, for every dollar you take out, you have to pay 10% in penalty. Plus, you have to pay taxes on that money because it wasn't taxed when it went in, and it's 100% taxable when it comes out. Not only the principal, but the gain. So you're saving the 10% penalty automatically. And all the distributions have to be between 1/1/20 and 12/30/20. Now, big notice here, it has to be 12/30/20. If you took the money out on 12/31, it doesn't apply. I don't know why they did that, but they did. So here's the big caveat, so you don't have a humongous tax bill. You can spread the distributions, spread on your tax return and pay the taxes over 3 years. So you can, so if you had 90,000, for instance, you could have $30,000 extra taxable income every year. This can be good or this can be bad, and we'll talk about that in a minute. Also, part of that, taxpayers can recontribute the money, put it back into your retirement plan anytime over 3 years. Right now, it's 60 days. That's the law. But for 2020 only, it'll be over 3 years. You have time to put it back. So we're going to have a 2020 return, 2021 return, and 2022 return. That's all going to be affected by these distributions. Here's the qualified plans that apply to, and really you can see it really just about is everything. There's a few specialized plans that it doesn't cover, but primarily it covers everything. It has to be available for rollover contributions, and the administrator, like with your 401k, has to agree to it. But that's really not true either, because the IRS has made a special form that if your administrator doesn't agree that you had COVID issues or COVID-related issues, that you can still fill this form out and say, yes, you did have COVID-related issues, and apply the credit. So what's an impacted taxpayer for COVID-related issues? An impacted taxpayer is defined as a taxer spouse or other member of the household who experienced adverse financial consequences as a result of being personally or having a spouse or dependent diagnosed with or quarantined due to COVID-19. This is very vague. So let's say you lost 1 day of work because you had to take your child to the doctor to get tested. That qualifies you to take the money out of your retirement plan. Let's say that you yourself had to go get tested, or one of your family members had to go get tested, even if it was negative, and you had to take some time off, or it impacted you in any way, that would qualify as being affected. Adverse financial consequences usually include furlough, laid off, hours reduced, unable to work, lack of childcare, closure or reduced hours of your business, reduction in pay, or self-employment income. The limit is 100,000. Can't take more than 100,000 out. And also, the fiduciary responsibility of the bank that you're getting it from, or the retirement plan that you're getting it from, is supposed to charge or hold back 20% of your distribution for taxes, and that has been waived for 2020. Okay, before I go back to this, let me talk about this one more time. This $100,000. I see a lot of amended tax returns being done for 2021 and 22 because of this. Let's say that you take $100,000 out. In 2020, you decide, okay, I'm going to pay $30,000, the taxes on $30,000. No problem. So let's say in 2021, you have $100,000 income and you're in the 32% tax bracket. You can go back and amend 2020 because you're only in the 15% tax bracket and include more income on that one and less income on the second year. Okay, let's say that the second year you have no taxable income. You can take more of it that year because the first $30,000 or $40,000 you don't pay taxes on anyway. So let's take $50,000 of that and pay the taxes on it. So you're going to be playing with all three of these years. I see a lot of amended tax returns going on for these 3 years and multiple amended tax returns. I think this is going to be a major problem. Okay, net operating losses. You get in 2018, you cannot carry back net operating losses. You can only carry them forward. Prior to 2018, you can carry them back 2 years or carry them forward 20 years. There was no more carryback after 2018. That has been changed. So let me go back here. So in 2020, you can now carry it back and it's automatically going to be carried back 5 years unless you decide to carry it forward. So you go back and you recapture the taxes that you paid in 2019, 18, 17, whatever. You keep carrying it back until you use all of the carryover loss. The one thing about this is it will be used toward back taxes. So if you owe back taxes, when you recapture that tax money, you're not going to get it in cash. It'll be used to pay off the liens, pay off your back taxes, pay off your college loans. Moving forward, when in 2018, you were not allowed to take 100% of your carryover losses. You were only allowed to take 80%. That has been waived for 2020 and has been suspended until 2021. You can go back, you can take 100% back or forward of your taxable income. Okay, so the amounts recovered on the NOL filings will be applied to back taxes. We already discussed that, and it won't be refunded to you. Excess business losses. This is an interesting topic, and it's one that's been through a lot of ups and downs over the last few years. This was starting basically in 2018 with the qualified business income tax deduction. So the basic rules is that you can, as of 2018, you cannot take business losses against personal income. And there's some good sides to that and there's some bad sides to that. Now, the CARES Act suspended those EBL rules for 2020. And so you have to really think about how you want to apply those or how you're going to use those. Let's take an example of, go back. Let's take an example of, we talked about before. So if you had a $50,000 loss in business income and you had $50,000 in personal income, you can get rid of that whole $50,000 of personal income with your business losses. But you're only going to pay taxes on probably about $40,000 of that. So you really lost $40,000 that's really not benefiting you at all. You're taking losses against money you wouldn't have to pay taxes on. So going forward, if you take it for business losses against business income, I think it's better in most cases because there's a lot of money involved there that you will not have to pay taxes on anyways that you're losing your business losses against. And of course, if you had $150,000 of business income and you want to take $100,000 of your loss against it, you're still saving a lot of money, the $50,000 of taxable income. You know, that's a little bit confusing, but you really need to talk to your tax provider to see what would be the best way for you to move forward on that one. Okay, donations, we talked about this a little bit already. Corporations went from 10% to 25%. And also went from 15% to 25% for food donations, which really applied to restaurants and for food suppliers. Employee education expenses. This has always been a fun topic for me anyways. It's one of those areas that you can save tax or save business owners a lot of money. If you have a child that's in college, you can give them a employee benefit by paying their college funds through your business if they're an employee. So I know in my son was in college. He was in college in another state, and he worked on my website. So I paid him to work on my website part-time and paid his tuition through my company as 100% tax deductible as an employee benefit. So one of the things that changed with the CARES 2 Act is that was expanded also to be able to pay for not only education expenses, but also the student loans. Never before could you pay off your employee's student loans as an employee benefit, but now you can as of CARES 2. So the maximum for that is up to $10,000 or $5,000 per employee. That's an employee retention credit. I'm sorry. On the student loans, I don't think there is a limit on the student loans. You can pay as much as you want on the student loans as an employee benefit. So this is the employee retention credit. There's a lot of employee benefits this year for employers. This is you would able to pay a maximum of $10,000 or $5,000 per employee. If you were closed due to COVID, you can still pay your employees and get a deduction on their taxes and their cost of their payroll. So of course, they had to be at least partially closed due to COVID, and they could not telecommute. If they could telecommute to do their job, then they didn't qualify. All of these employee credits are not available to you if you took the PPP loan. Just remember that, including the one I just mentioned. Emergency Paid Sick Leave Act, that was also part of this. So you could pay for your employee to be out sick, pay their wages under the Emergency Family and Medical Leave expansion. The two programs are completely separate. You cannot pay them under the Emergency Family and Medical Leave Act and also pay them for the employee retention credit that we talked about before. It's one or the other. And again, you can't take any of these credits if you took the PPP loan. Okay, the EPSLA is also for fewer than 500 employees, and the reimbursement for sick leave is paid to employees unable to telework. We already talked about that. The other requirements, it's a subject to federal, state, and local quarantine isolation. This is how they qualify. Has been advised by a healthcare provider to self-quarantine, experience symptoms of COVID and seeking a medical diagnosis, caring for another individual who meets one of the above situations, caring for a child because of the school's closure and they have to take care of them, or unavailable due to COVID precautions, and it's been experiencing any other substantial similar condition as specified by the DHS, Department of Health and Human Services. So the employees can be paid up to 80 hours of sick leave for this credit. And there are some other rules that go into effect about how much they can be paid and at what rate and so forth. So you need to check with your payroll provider. You may have to redo your 941s for the fourth quarter to take the credit, but that's well worth it. Self-employed, there's also some programs to defer the employer portion of the self-employed taxes. So you still figure out your self-employed taxes, and then you can defer half of them, but the taxes do have to be paid by 12/31. Have to be paid, I think it's by 12/31/22. So they do have to be paid back. They're just deferred for the moment, which is really great. If you were not able to pay all your self-employment taxes, you can defer half of your Social Security and Medicare to 2 more years without paying the interest and penalties on it. So they do have to catch up on it and they have to pay it by 12/31/22. Okay, employees who chose deferral. There was a program for the last quarter that an employee could choose to have their Social Security and Medicare waived for the last quarter, and then they would have to repay it beginning in January 2021. Personally, I had a lot of clients who wanted to do this for their employees. And once I told them I wanted them to sign a waiver explaining they understood all the risks involved, nobody chose to do it. The way I look at this, and other tax professionals look at this, if the employee waives all of their wages or the Social Security, Medicare payments, and you don't pay them in, and then the employee quits or gets fired, those payments still have to be paid. And legally, the owner is responsible for Social Security and Medicare payments. So when I started explaining to a lot of, especially restaurant owners, that if they weren't there to pay it back, then they were probably the owner themselves are going to be responsible for paying that. Then they decided not to allow their employees to take that. I don't know of one colleague of mine who had an employee or a company take this program for their employees. Nobody wanted to take the risk of it once it was explained to them. Self-employed, there is credits for sick leave and family leave available for self-employed individuals. Also, there's a new form 7202, which is tied to the self-employment SC form, and you can talk about that with your tax professional. Now, there's a lot of different things of the regulations that we have not had a chance to review, and we probably won't, but I want to still go over a few of them. The SBA is paying for the principal and interest and any fines for taxpayers already having a microloan or a 504 loan through the administration, and they're going to do the same. And they're doing the same things for loans issued prior to 7/27/20. This does not include EIDL loans, and it does not include PPP loans. So it's an automatic process, and you don't have to do anything about it. It's automatically going to be waived. And there's a IRS form 8827 if you want more information on it. Bankruptcy hurdles changed. It was increased. The debt limit was increased from 2.6 million to 7.5 million. The big thing is that 50% of the debt has to be from business-related debt. And then the monthly income from bankruptcy maintenance could exclude any payments due to the PPP or any of the other credits. So it's not going to be considered part of your income when you figure out what you're going to have to pay back or what your available payment plan would be for your bankruptcy. The business interest deduction that started in 2018, you're not allowed to have more than 30% of your income for your business come from interest income and still be able to get the QBIT. That changed to 50%. And partnerships are still not eligible for this in 2020. Clients who own rental properties, they've had a lot of problems this year. A lot of people cannot afford to pay the rent. And so there was a lot of different programs and pieces of legislation to help protect the renters and to basically help the property owners pay their mortgages. So one of the things was if one of the programs came in, either the Housing Authority or SBA came in and paid your renters' rent payments to you, they would only pay 50% and you had to consider it completely paid for. And then that 50% that they paid you was taxable income. Well, they changed that, and now that portion that the programs paid you to forgive the debt of the renters is no longer taxable. So the first program was to assist property owners who were in some kind of problem for at least 6 months or longer, but they still only paid a few months of the rent, and they had to consider the whole thing paid for. And a lot of clients have come in and asked if they get to claim a deduction for the rent they did not receive, and no, they do not. You don't get a tax deduction on something you haven't paid taxes on. So originally it was double-edged sword, because if they took the money, they also had to waive 50% of the rent and then still pay taxes on it. But CARES 2 changed that, and so it's not, like I said, the payment's not taxable anymore. There's a lot of new forms. I'm sure you guys know about the 1099 NEC. I'm sure you're already used that this year. There's a lot of other new forms that we're not going to be able to go through. So this is 1 year. You probably really need a professional to go over your tax return, especially if you own a business. There's just a lot of things that you can take advantage of, and there's a lot of things you may have missed that you didn't know about. Some of the other things that changed, the collections and representation changed. The IRS has, implemented some changes for the taxpayers with examining collections. This includes extension of time frame to pay the short-term loans. Before it was 120 days. Now it's 180 days after you file your tax return. You don't even have to file a form if you're going to pay them within 180 days now instead of 120. They're very flexible for taxpayers and offering compromise. I had about 4 or 5 cases this year that I started in 2019. Every single one of them got approved. There just weren't really doing a whole lot with them. One, because they didn't have the employee manpower at the IRS, and 2, everybody could show that they were being harmed by COVID and they didn't have the income, so there was really nothing they could do about it anyways. So they had a lot of forgiveness for offering compromises. A lot of payment plans were stopped because of COVID automatically and then started up at their own time frame, which is usually around June or July, when the IRS started to start the automatic payments again coming out of their checking accounts. And then one of the big changes is if you owed under $50,000 before, you could do a payment plan without showing financial information on your bank accounts, 6 months of bank accounts, 3 months of utility bills, everything. Now they've changed that for 2020 to anything less than $250,000. That's huge, huge. So being able to have a payment plan of $250,000 without showing any financials is just really unheard of on federal lien. Okay, IRS will add certain balances to current installment plans without having to go into default first. Right now, if you have a payment plan and then you owe money for your newest tax return, your old payment plan would go in default because now you owe new taxes and you'd have to call them up and go through the whole process again. Now it's going to automatically be added to the plan, and so you don't have to go through that process. There's also an online tool now that you can go in and you can say, I need to reduce my payments, or I need to change the date of my payments, and that you can do online also without having to actually call an IRS collections. Questions? There'll be a lot of questions, a lot of information. I'm going to unshare my screen here, I think.
All right, well, thank you so much. I have a question that I heard on the news, but I wanted to see if you had any insight on this, Sandi. People are working from home and they're getting up and moving. They're moving because they're able to work from home, so they're moving to a different state. So what is the tax consequence when it comes to that? Let's say your husband gets relocated, you're a realtor, you're moving out of state. What's the tax situation? Do you know?
Prior to 2018, you could take the moving expense deduction, but that went away in 2018. So the only people who can take the moving deduction is those that are in the military, active military. So there is no deduction for you whatsoever as far as the moving expense. Most of the companies will pay this for you if you're moving with the company and they add it to your W-2. But it will become taxable income if they help you move also. The other thing is a lot of people are asking about working at home and being able to take home deductions. As of 2018, you can't do that as an employee. If you're self-employed, it's the only people who can take the home office expense. So there's been a lot of questions about that too.
Okay, so we have a question from Joe. Corporation filing tax date changed, question mark?
For 2020 tax returns, no, they're still the same. 2019, the S corporations did not change, but the C corporations did. By the time they made the announcement of extending the tax deadline in 2019, the S corporation deadline had already passed. So it didn't apply. A lot of people thought it did. A lot of people called in the IRS and asked if it applied, and the IRS told them yes. And so I've got those penalties waived on those cases because of it. IRS didn't know what they were doing. Surprise, surprise.
Okay, and another question from David: Do we declare the stimulus funds as income?
No, it's not going to be. Well, there's a form on there that you have to show what money you received, but it's not considered income. The problem that we are seeing is that when you receive the checks in the first place, it was not subject to any of the holdings as far as, back taxes or anything like that. But there is no way of doing that with the new tax returns. So if you're getting the stimulus money, it's going to be used toward back taxes. I don't see how it's not going to be. They're fighting that in Congress right now, but there is no mechanism in place to separate that out.
All right. What's tax deductible regarding meals nowadays?
Well, for businesses, it's still 50%. You cannot take entertainments, and you can't take any baseball tickets like we had any, or concert tickets like we had any. Can't take those at all. So if you go to a baseball field and you cannot pay for the tickets into the baseball field, but you can pay for their meals while they're at the while they're watching the game. So,
and this applies for self-employed also?
That is yes, definitely. It's a business expense. A lot of times now what's happening is you're buying a box for $2,000 and it includes all the food, and they're saying only $10 of that box per person was for the tickets. So that way they can write off 90% of the box for meals and meals. So that's kind of what they're doing now, but you have to play the game a little bit, I guess, there. So
yeah,
but still 50%.
All right. I think we've answered all your questions.
I do want to add one more thing real quick to that. If you are providing meals for your employees and it's for the benefit of the employer, for instance, during tax season, I bring lunch in for my employees, I can write 100% of that off because I don't want them to leave the office. I want them to stay and do tax returns. So if you're work on a construction site and you're bringing them lunch or bringing them water, all of that is 100% tax deductible.
Okay, so we incurred a couple more questions, Sandi.
Okay.
Is it better to have an S Corp in place if I received husband Social Security benefits as a realtor?
Husband Social Security benefits as a realtor. An S corporation, see, if you're losing money, if you're limited on how much money you can earn, an S corporation can help you because you can take passive income and that doesn't apply. If that's what she's wondering about. But most people who are getting Social Security benefits for the husband, they're limited on their income and how much they can receive without having to pay some of it back. And that's the best way to get around it. So you take a very small wage and you have the rest of your income come from passive income on the S corporation.
All right. So there's a thank you for that answer. Another question, is there a tax consequence when sale of your home and you are able to and have designated certain square footage for your business?
Well, that changed. In 2018, generally we take the simplified method for the home deduction, which is $5 per square foot. You don't take into account any utilities, you don't take any account of depreciation, nothing is happening. So you just take the $5 per square foot. It usually ends up more anyways that way. And you can do that up to 300 square feet. When you do that, you're not depreciating your home and you're not declaring part of your home as business. So you don't have any issues with income, or making part of it business income if you do sell it. If you have been using it and depreciating it, wait 2 years before you sell your house. It's a trick.
Well, we don't say that because we don't know what the market's going to do in 2 years.
Well, okay.
All right. Okay. Again, thank you so much, Sandi. You always are a wealth of information. We knew that we had to bring this to our members while you are available, because after this, you're going to be so busy, you're going to be hard to get a hold of, right?
Right.
All right. Thank you again, Sandi.